Hi, I'm Steve Van Metre. Welcome to your weekly economic update. For those of you who've been following along, my wife her recovery's going pretty well from her back surgery. Obviously, I'm sure it feels like she got ran over by a truck due to the nature of the operation, but she is progressing, and probably by the time, if you're watching this, say Friday evening, I'll either be on the road or be down there, and with the expectation she's coming home Sunday. So hopefully everything will continue to progress nicely. But let's talk about what's going on in the economy. We have a really big drop in payroll numbers from January's 300 plus thousand to 20,000, and this 20,000 came with a big revision onto the birth-death model that would have actually made this a negative number. And this shouldn't come to a surprise, and I said this last month when we talked about the non-farm payroll report, is 4 months behind. So the 300,000 was due to hiring in September. The 20,000 would have reflected October, and while the stock market and the economy went down in October, November, December, so guess what's coming in the next couple payroll reports? Then you have January government shutdown, and people probably aren't hiring then. And now we're seeing reports even now in February saying the economy's slowing. So you've got really 3 to 5 months of pretty slow payroll reports coming. And that's not going to be good for the equity market bulls who are hoping for higher inflation and higher equity prices, but just doesn't happen when you have a slowdown in hiring. But it's to be expected because we're at the end of the cycle. The Fed's been tightening, and eventually all these lags from the Fed's raising the interest rates, tightening the monetary base, it all comes to roost. And now it's starting to happen. The only part that we're not seeing is the stock market confirm it because of all the corporate share buybacks. And this is a problem that investors saw back in the last two peaks. They couldn't see that the end was already showing up, because they're too focused on price, and they've gotten conditioned over the last, say, 8 to 10 years. It doesn't matter what earnings are. It doesn't matter what the economic data is. Stock prices are just going to rise. Well, they're just going to rise because corporations are making this final bid to boost their stock prices up. And what did we see this week? Huge outflows due to corporate executives selling. So we know what's going on, and when the first quarter earnings start to kick in, which is not next week but the week after, well, we're going to start to get some information that says, no, the first quarter wasn't that great, and that should lead stock prices much, much lower. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell a security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre. My own personal passive views expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So let's take a look at the charts since we're here. We got the M2 money supply continuing to slow down after its little bump where money came out of stocks into money market accounts, but it's resuming its downward slide. Now, under full disclosure, the 6-month rate of change did technically increase this week, but the overall trend is down. So I listed it as falling. It's at 1.81%. The 3-month rate of change is now under 1%. And the broad year over year is at 4.11. Remember, 3.7. We've hit this number before and bad things haven't happened, but you can see the economy really slowing down. And on a year over year basis, the growth rate of the money supply decreased 12 billion, and this has got nothing now left. There's no more fiscal stimulus, no more monetary stimulus. It's all over. So this thing should continue to slide. Looking at commercial industrial lending, this actually is incorrect. Let me see, growth rate down slightly. And the magic of movie editing, down slightly to 10.2% from 1.56% a year ago. So now both the front end and the back end numbers fell, but this starting next week should start to ramp up, which should put downward pressure on this, because I suspect commercial lending is slowing, and if that is correct, that should cause the dollar to roll over. We'll see. Consumers are picking back up their credit card spending a little bit, maybe post-government shutdown. Not really sure what the driving reason is, but the Fed has said this week that credit card debt is at a record high, and most of the charges are going to day-to-day expenses. So not going to fund things like vacation, but to pay things like utility bills and groceries. Looking at the Federal Reserve balance sheet, dropped $5 billion for the week. Again, as I've been saying, there's no indication of a Fed bailout of the stock market here. It continues to slide. It's now under $4 trillion, and this should keep going down, 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 and down until, of course, they stop it. Bank deposit growth rate was up a little bit to 1.67, but still extremely low as deposit growth is just decelerating as interest rates rise. That's not exactly the trend you want to see. But for those who keep thinking that interest rates are going higher, I thought this was worthwhile as we're starting to get caught up on, or at least the government's starting to get caught up on where the speculators and large money managers at. But you can see that on the 10-year Treasury yield, you have long contracts under 100,000, so not many people. Short contracts over 600,000. So imagine when all these short contracts start to get unwound and are forced to buy, because that is what happens when you go from short to long. You either directly or indirectly become a buyer. You can imagine how low interest rates are going to actually go when all of these people figure out they are on the wrong side of the trade. Looking at world trade, I saw this hit Twitter this week. It's pretty interesting that when world trade crosses below its simple moving average, and I'm looking up here to see, it's 20. Looks like it's 25 week moving or 25 week moving average. Looks like that tells us that the economy is slowing down, and we know world trade is slowing down because world dollar liquidity is drying up. And this was one to keep in mind for later. The risk parity index, which is a model that goes from stock to bond based on volatility, has bought back stock all the way up here. Now, this thing has gotten trashed here and here. It's going to get trashed again because somehow these smart money, I think they're just trading around what these computer models are doing, trying to flesh out money from these models. But this is going to be interesting when we look at where Treasury yields are at as of today, knowing that you have a model that is heavy stock-based that can turn and buy bonds when volatility rises. That's what I want you to keep in mind. This was an interesting graphic that was put out by Elliott Wave International. Is an accommodative Fed bullish for the stock market? Well, the answer is no, but the other side is by the time the stock market starts going down, the Fed starts to ease. It doesn't really stop it, only because the monetary lags have to get pushed through the system. It's not until then that the market rallies. So here we have 9 Fed rate hikes, and we have 10 cuts, 10 cuts. So we know what's coming. The only question is, at what point does the market give up and the Fed show their true colors? And then we have the agricultural sub-index. Crop prices are at their 50-year lows. Now let's just put this in context. If stocks were at a 50-year low, people would buy. If bond prices were at a 50-year low, people would buy. If oil prices were at a 50-year low, people would buy. You want to buy low and sell high? Maybe this is buying opportunity you've been looking for. All right, so with that, let's jump over and see what the banks are up to. And we'll switch over to here. And when we look at this, as you know, we're looking at the Fed H.8 release that shows assets and liabilities of commercial banks. Remember, we had an increase in the bond market, and let's see if the banks had anything to do with it. The answer is no. They actually added $1 billion worth of treasuries, not much. They shed $3 billion of mortgage-backed securities and added some non-mortgage-backed securities of $4 billion. So they were net buyer bonds, but effectively they were flat over last week. So we now know for sure that that move in the bond market was the Federal Reserve doing a reverse repo. So let's go and take a look at what's going on in the charts. And we've got the S&P 500 smacked into resistance and sold down. Closed under its 200-day moving average, this tan line. Generally considered a bearish signal, but did manage to get right over this support level here that I've got at 27.35. Although if I drop this band down, we could actually say it goes kind of right up into here, right roughly about where it's closed out today. But here again, for the last 200 days, the stock market is effectively zero return. And if we go back far enough, we can say it has been a zero return since January of 2018. So that's 15 months of effectively no return. And now we're starting to hear some investment banks saying a retest of the lows are coming. And I've said that is going to happen. Markets never bottom off this. Now, if we do bottom here and it holds and starts to rally, then that would suggest that we are still perhaps in a bull market. Hard to believe that that's going to happen. If it breaks through and goes below, that's the final confirmation anyone needs of a bear market. This should have a fairly deep sell-off, which would be a buying opportunity, knowing that at some point the corporates come back in and buy their shares back after the blackout period, which will go between mid-March and into, let's just say mid-February or mid-April. Not mid-February, can't go backwards. But there should be a pretty deep sell-off here because this is all mostly computers and corporate share buybacks. The computer models based on Nomura's data from their CTA quant models is starting to show that they're flipping from buying into selling. So this could aggravate a move down when you look at how weak liquidity is about to become. And the best proxy for liquidity is the bond market. And when the bond market is rising, it creates liquidity. When it's falling, it sucks up liquidity out of the market. And look what happened. Today, it briefly crossed over its line of doom, where if it gets underneath here, it triggers a big short sale to bring the market down. And we can zoom out and we can see all these people in here are short, short, short. And as it pushes down here, they're going to unwind these positions and most likely drive yields, at least 10-year treasury yields down to 2.3. I mean, I'm going to leave this dashed line on here for now, and it wouldn't surprise me if it hits 2.3 and we get down all the way to where it was before the election. Wouldn't surprise me at all, but the bond market is telling us that there is a deeper sell-off coming because remember now, think about those risk parity models, right? Those risk parity models are mostly back in stocks. As they shift to bonds, they're going to push liquidity out of the market and they're going to drive this down, forcing all these people who are short to sell other assets to cover their bond shorts. And well, that's why we looked at that chart that showed how many people are short, because there's a lot. And that could easily drive the stock market way, way, way down. Looking at the 5-year treasury, as we see they broke through here, suggesting that their time up in this range is short and that they're going to head lower, and they've got a ways down to go. We could see them getting down to, let's zoom out, pretty much just right around under 2% here. That would be a pretty easy move with a much stronger level of support right here down at 1.8. So that's telling us 5-year yields are headed lower. Let's take a look at the 30-year bonds. They crashed below their 50-day moving average. So again, all that move by the Fed, that reverse repo, got quickly unwound by the market. What we don't know is exactly if that reverse repo is over. I mean, if it's not, that even is more interesting, because if the Fed actually gets that $117 billion back and returns those bonds, that's going to drive the bond or drive bond yields down. And the next week we've got, I think, 3 longer-term bond auctions. I'm not sure if it's the 7-year. I know we have the 10 and 30-year. So that's going to pull liquidity. So we're getting this setup now going into, again, that corporate share buyback blackout that I thought was going to happen last quarter. Now we're setting up for it again, except the conditions are much worse because the bond market's about to just literally yank the plug on liquidity and leave everybody scrambling with the world's largest buyer of stocks right now, corporations, unable to buy. Makes it very, very interesting of what is coming here. Looking at the ETF symbol SPY, we see volumes just are not real strong here on any of these moves. So we're not seeing any major liquidation going on to suggest that there's anything other than just people selling off of this peak, because we hit, again, resistance at 2,800. This is where the sellers are at and where buyers are running out of money. So we look at volume and we're not seeing anything that would suggest that this is a big sell, but look for it to move lower over the next couple weeks. When we take a look at gold miners, say, look, they bounced. They're back over their 50-day moving average. Okay, let's go look at physical gold, because this is going to tell you what you need to know about the gold miners. And we can see that here was support. We broke the support, came back up, and it tagged at support, and at the moment has failed. I think it closed at 1301. I don't know why this is at 1298. But nevertheless, support is now becoming resistance. If this holds as resistance, the next move for gold is back down to 1240, and based on Nomura's quant models, they actually are going to hold their positions on gold even down here. It's not until they get under 1200 that the quant models start to sell. So that tells us that realistically, gold is headed back to 1240, kind of where I thought it was headed to begin with. And that tells us for the gold miners, they're headed back down somewhere right in here as well. And that's exactly kind of what we were looking at with all of these major moving averages. We got the daily sitting right under here, and then we can look at the weekly moving averages. They're sitting right underneath here. That's good. And then you've got the monthly moving averages sitting right down underneath here too. So all this support is telling us that a move down for the miners is not necessarily a bad move. It would actually start to confirm that we are in a bull trend. And these moving, I mean, it doesn't have to hold these moving average exactly. If it kind of drops down to here and starts to bounce, that's pretty much good enough. And the reason we know that, again, going back to the physical metal, there's support is right here, and then there's a lot more support around 1200. So that'd be interesting to see, you know, how gold handles this when equity markets go down, but I suspect gold will be sold, and then where it firms up is where the big players are at. And if that firms up down right in this 12 to 1250, then we know that's where the big players are at. That confirms that is probably the bottom of this phase here. That's where we want to go. And that's not unusual to see these first move of a longer upward trend to come down and retrace, say, anywhere from half to 2/3 of its upward move. So if we looked at, say, this move was from 1200 to 1340, so that's 140 points minus a 70. That takes us down to 1280. So it came here, but really that could be easily retraced down to right in here, this 1250 range, and totally validate the initial phase of a market rally. So I really like what's going on here, and that would validate starting to pick up the positions that I've been wanting to pick up for way too long now. Let's take a look at silver miners. Again, they're suggesting that they're going to come right back down and hit 24. They're a good proxy for what's going on with gold. So that tells us that, yeah, everything we're seeing there looks about right. As far as the oil and gas producers, we can see they broke below their 50-day moving average. I've been expecting this, a retest of their December lows. And they tell us a lot about what's going on in the broad market, because the broad market followed oil up and is not totally following it down. So when I overlay the S&P 500 in purple here, what we can see is the S&P 500, if we go down to right here and go across, should be around 2480. Now, is that realistic? Well, let's go look at the 10-year Treasury market. You see they follow each other pretty good. Yields are down here, right at 2,500. So yeah, it tells us the stock market needs to come lower. The only question for the broad market is, does it hold this bottom in December? Don't think it will, but if it does, that is very constructive for the market. If it doesn't, it tells us we are actually in a bear market. So that's very interesting again. So I suspect we'll see some further downward pressure on the oil and gas producers, mainly because as the monetary base contracts, oil prices fall, demand falls. We're seeing it in the payroll reports. So it's getting very, very, very interesting. Let's continue on to emerging markets, where I'm getting pretty interested in seeing where this thing stops out. So here's the spot where we'd like to see it kind of stop right around 40, 41. Now it could triple bottom down here at 38. If it does form a bottom and go, that's going to tell us that the dollar is headed lower. And there's a lot of support. We could take this line, duplicate it, and bring it down here and say, look, there's lots of opportunity all the way throughout here for emerging markets, and it will be interesting to see where it goes. I'm going to doubt that it's going to come down to 38. It could. I doubt it. If it does, that would be very interesting, because it normally doesn't do that. But we know there's some big players that bought in here, and we'll see how committed they are to their trade. Because again, that's telling us what's going on with the dollar. Now, a lot of people right now are saying the dollar is going to take off, but I think that due to the rollover of commercial industrial loans, that should take some pressure off of the dollar and bring it down. It'll be interesting to see, because right now there's a lot of positioning for a rising dollar. If it rolls over, what gets interesting about the dollar rolling over is you got the bullish narrative for gold, the bullish narrative for emerging markets. And that's really cool. That's what we really want to see. And agricultural commodities. So you start getting this weaker dollar theme kind of plays into what I'm looking for. So we kind of see how that plays out. But I like the emerging markets there from an equity position, or just an equity stake, as long as they can hold somewhere in there. And there's a lot of support here. So we'll see how far down it comes. If we look, let's take a look at the weekly moving average. I didn't look at this before. But you've got the 200-week, look at that, right there in the middle of those two support zones. The 50-week moving average got rejected. So again, it's going to tell us it's coming back down somewhere. Where it stops is a big indicator of where we want to jump on some opportunity there. And I like that a lot. That would be, in my opinion, a fairly low risk entry point, depending on where it stops. Looking at the 7 to 10 year Treasury bond ETF, remember, we got a cross over the 50-day moving average, and we didn't confirm it, but it crossed back over. This is, again, a very bullish signal. And at this point, you can see it's consolidating here. It doesn't take much now to push this over, and you start to ramp out some of these short sellers and get much, much lower interest rates. Looking at the 30-year, it came down, held its 200-day moving average, but it's gotten back over its 50-day now. It's setting up for it to get through its overhead resistance level and take off. And you can see all these short players sitting right in here are going to get flushed out. I mean, look at the 7 to 10 year bond. You've got all this short positioning in here that's going to get flushed out. So this gets really, really interesting from a liquidity standpoint when you look at the broad market and how I suspect it is going to sell off. We take a look at crude oil. It's managed to get over its 100-day moving average. It would need to confirm its 50-day to validate a bullish trend. But again, I suspect that crude's going to revisit and potentially drop below 42 here. And that would, again, spell bad news for the broad stock market. And then last but not least, we'll take a look at the ags. And this is pretty interesting. It was a couple of days ago, and it's one of those things I meant to save it, and I thought I did, and I couldn't find it later, and then I realized I didn't click on the right spot for saving. But someone who had a lot of knowledge about the farming sector said, look at the weather, the wet conditions between last year and this year, and he's like, it's much wetter. It's like this is bad news for anybody who's short agricultural commodities, because when they start to figure out that you can't plant in this weather, because again, hybrid crops require ideal planting conditions, ideal growing conditions. I mean, they're very specific. You plant during this narrow week window, you do these things for so long, and then you harvest during this narrow week, this narrow range. And if anything is wrong, yields can fall or you can't plant. And so right now, I mean, look at the farmers' positions. You have the highest number of farm foreclosures in the last 9 years. You have wet conditions that are going to keep them from potentially planting when they need to. And you have low prices, which maybe they go and say, hey, maybe we won't plant. Maybe they'll kind of informally create a little union and say, look, we're going to step out, let some of this inventory go down. We'll see. It's going to be really interesting because, again, when you're in the solar minimum, you get these colder weathers, you get these shifts in the weather patterns every 11 years, which we're sitting at right now, is super bullish for crop prices. So, and that day is coming. It would only be accelerated if the dollar goes down, and that would be pretty crazy if they both happen. And I think it can. That's not a very broadly held view. But then again, I'm not known for broadly held views. But anyways, we got a little bump here. We've seen that last couple of days. We'll see if this is kind of the final bottom. Traders are saying that this thing's really got to get up into this range here before it's going to draw some attention. I'm going to go and say it needs to get up here to its 50-day moving average before people start really looking at this again. But the sector is the most beat up sector in the market at its 50 years low. And much like everything, when people say, oh man, I remember that one time I bought low, but it's interesting when things are in the toilet, it's not most people don't want to buy. That's where you make most of your money. So keep that in mind as we look forward. So I'll be back plan on hopefully Monday, assuming everything goes well with my wife. She comes home Sunday. I'll be back Monday. The people that follow the hedge fund data saying that finally the government's caught up. So that means this weekend I should get it, which means Monday we can actually look at it because it's all just been delayed. So we were not getting the close to real-time information we once had. But it's things are getting set up big because we got those Treasury auctions next week. We have options expiring. There's what's called quadruple witching day. There's a lot of options expiring at the end of Friday, and then the following week we go into the corporate share buyback blackouts begins, and man, there may not be any liquidity in this market. And if we start seeing these computer models selling all the way down into an illiquid market that are buying bonds, get a big plunge in stock prices, and that is what you look for, the buying opportunity, because we know the corporates still got some money left in their tank. Not a lot, but we know it's there, and lower stock prices means they can buy more shares back. So that's why I think this thing runs out of steam at 2,800, because they just don't have enough money to keep pushing it higher. But they do, if stock prices drop, say 10 or 20%, would be very interesting. Wouldn't surprise me if we actually get, in the next 3 months, a revisit of the pre-election lows, somewhere down there from back in 2016. Wouldn't surprise me at all. So I'm Steve Van Metre. I'll be back with you on Monday. If you have questions, give me a call. Send me an email. I'm here for you. Bye now.